In today's video, we'll explore a scalping strategy designed to recover losses quickly by targeting large profits with tight stop losses. This approach also shields you from false breakouts, helping you prevent unnecessary losses from overtrading with repeated entries. Regardless of whether the market is trending or moving sideways, this method functions in all conditions, delivering a strong win rate. If you want to regain your losses with this strategy, you'll need to carefully stick to the rules shared in this video. Only then will you be able to achieve consistent profit. So, let's break it down in detail. But before we continue, if you find this content valuable, hit that like button, and if you're new here, be sure to subscribe and enable notifications so you won't miss our latest uploads. I'll catch you right after the intro and disclaimer. In this scalping strategy, we'll mainly rely on price action along with the 9 EMA and 30 EMA, or the exponential moving average indicator, which helps identify overall market trends. For instance, if the price on the chart consistently trades below the 30 EMA for an extended period, it indicates the market is trading at lower levels. The market is in a strong bearish phase with the price rejecting the 30-period moving average, EMA, line while treating it as resistance. Likewise, if the price steadily trades above the 9 and 30 EMAs on the chart, we take it as a bullish trend signal. The 9 EMA remains positioned above the 30 EMA, using the 30 EMA as support. Whenever the price touches this EMA line, it rebounds and continues its bullish direction. Also, whenever the market is sideways, the EMA lines move flat and close to each other, while the price trades sometimes above and sometimes below these lines. When there is no clear fluctuation in the EMA lines on the chart, we call it a sideways market. Therefore, if you are buying options, you should only take entries in trending markets and always avoid trading in sideways phases. Since we scalp intraday, we will apply this strategy on the 3-minute time frame. If used on higher time frames, you'll receive delayed entry signals. In smaller time frames, you'll notice higher volatility, which often results in fake breakouts. That is why we apply this strategy on the 3-minute chart. To generate profits using this method, you must strictly follow the rules outlined in this video, and these rules are quite straightforward. Rule number 1. If the market is trending bearish, then unless a strong bearish candle closes with the 9 EMA crossing below the 30 EMA from top to bottom, we should avoid entering a short position. Rule number 2. If the 9 EMA crosses the 30 EMA from bottom to top, but the closing of the candle formed at the crossover is too far apart, then no trade entry should be taken. Rule number 3. If any candle crosses above the 30-period exponential moving average, EMA, and closes near the 9-period EMA, we can take a short trade here with a tight stop loss. Let's see this on a live chart. For example, on the 3-minute timeframe chart of Nifty 50, as soon as the market opened, a large bearish candle closed below our 9-period EMA, trading under the 30-period EMA. This candle also broke its previous low, forming a bearish price action setup. At this point, many traders entered short trades after the candle's close, but the price dipped slightly and then reversed, leading to losses. However, if you notice carefully, the price was already far away from its 30-period exponential moving average line. That's why we avoid taking a short entry here, because whenever the price extends too far from its moving average, it tends to pull back toward its average price. Therefore, whenever the price moves away from its average, it naturally tries to return. If the price breaks out far from the breakout point, you should avoid entering trades in the same direction of that breakout. Always keep this principle in mind. The same scenario occurs. What happens is that the price moves away from its 30-period moving average line and makes a bearish breakdown, but then quickly reverses upward, trapping retail traders in the process. Also, on the same day, after the price rises slightly, the 9 EMA crosses below the 30 EMA with the closing of a strong bearish candle. However, we cannot take a short entry here because the candle that caused the crossover closed far away from the EMA line. Therefore, this setup is considered invalid according to our rule number 2. If we entered the trade here, our stop loss would become unnecessarily large, since the price has already moved far away from its moving average line. We will avoid this entry. Now, if you look at the chart, after trading above the EMA line for some time, the 9 EMA crosses below the 30 EMA along with the closing of a bearish candle. According to price action, the price also closes under the 24,400 level, making this a valid trade entry setup for a short position as per rule number 3. That's why we take entry below the candle's low here and place our stop loss just above its high. Our initial target is set at twice the size of the stop loss. Shortly after, the price drops further and hits a profit target nearly 5 to 6 times larger than our stop loss. In such a strong bearish trend, you can secure bigger gains by holding the trade with a trailing stop loss until the price breaks above the 9-period EMA and closes above it. Additionally, notice how many traders, seeing this strong bullish candle, may have attempted to enter long positions and ended up trapped. But by applying this strategy, you would have avoided the fake breakout, because the 30-period EMA line above the market acts as resistance. Since the price had not broken that resistance, rejection from this level was expected, pushing the market lower. Therefore, you should avoid making this mistake. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Let's now examine this strategy in a bullish trend. Understand the rules of how to apply it. Rule number 1. If the market is in an uptrend, then we should not enter a long position until the 9 EMA crosses above the 30 EMA line from below, along with the closing of a strong bullish candle. Rule number 2. If the 9 EMA crosses above the 30 EMA line, but the candle closing at the time of the crossover is far away from the EMA line, then a long entry should be avoided. Rule number 3. If a candle crosses above the EMA and closes near the 9 EMA line, then we can take a long position with a small stop loss. Now let's understand this with a live chart. This is the 3-minute time frame chart. After moving downward, the price pushes up with strong bullish candles and closes near the day's high, attempting to break higher. Many traders, seeing this momentum, rush to enter long trades, but the price soon reverses and hits their stop losses. However, if you apply the EMA here and observe, the market has not yet shown a proper move. It has not broken the EMA level, making it an invalid entry for a long trade. Later, as the price closes above the EMA level with a bullish candle and a crossover occurs, we then set a small stop loss. At this point, we can enter a long trade. The price continues upward shortly after and successfully reaches our profit target. However, here reverses after a sharp decline and begins to rise. A strong bullish candle breaks both EMA lines and closes above them. However, according to our EMA strategy rules, this is not a valid setup because although the candle broke the EMAs, there was no EMA crossover. For this reason, we do not take a long entry here. Shortly afterward, an EMA crossover occurs with the price, and the candle closes above it. Based on our setup, we can enter a long position with a stop loss placed slightly below that candle. But after entering, the price moves down and hits our stop loss, forcing us out of the trade. Since we entered according to the rules, our stop loss was small, which limited the loss. On the other hand, traders who enter without rules, simply hoping the market will rise again, would have faced significant losses here. This shows why it is essential to use a trading strategy and strictly follow its rules. Only then can you achieve consistency. After declining for some time, the price breaks out again with a strong bullish candle after 1 p.m., and the EMA crossover also takes place. Yet according to rule number 2, this is an invalid setup because the crossover candle closed far from the EMA line. Therefore, no trade entry should be taken here. Soon after, the price drops and once again breaks both EMAs, which now gives us a valid long entry with a small stop loss. Shortly after, the market rallies upward and successfully hits our profit target. Had we entered against our rules earlier, we would have suffered heavy losses. This is why an option buyer should always wait for a proper setup on the chart. Once the setup is confirmed, you can enter confidently with a stop loss, which helps build discipline and confidence. Additionally, if both EMA lines on the chart are aligned in parallel without any slope, We call this a sideways market. For instance, if you observe on the chart, the market trades in a range throughout the day. Although it drifts lower, there is no significant decline in the EMA line. The candle sizes remain small, with most opening and closing near the previous candle, which indicates buyers and sellers are uncertain about direction. Therefore, if candles are small and forming around the EMA line, you should avoid entering in either direction. For example, at 10:57, a bearish candle crossed the 9 EMA, broke the previous swing low, and closed below it. However, at the same time, if you check the premium of the 24,400 ATM put option, there was no increase. This shows momentum in the option had weakened, and the premium did not rise in line with the index. For this reason, it's very important to track option premium momentum along with the EMA strategy. That's it, traders. Thanks for watching this video. The difference between staying stuck and moving ahead is action. If this video helped you shift your mindset or improve your game, drop a like right now. And if you haven't already, subscribe and press the bell icon so you're always updated when the next strategy lands. Stay focused, stay intentional, and never stop learning. I'll see you in the next video.